Welcome to Simply by Deal HQ. On this podcast, we engage thought leaders on topical issues around law and business in the most simplistic manner.
Hello, everyone, and welcome to episode 2, season 3 of Simply by Deal HQ. My name is Precious Omope, an associate at Deal HQ Partners. Today's conversation is focused on the ongoing petroleum licensing round, a process that has attracted significant attention across operators, investors, financiers, and consortium participants, both within and outside Nigerian borders. Presently, we are at the registration and pre-qualification of applicant phase, which is scheduled to be completed by 27th February 2026. We have with us two industry powerhouses that will help us dimension our topic, the more nuanced considerations to submitting a winning bid that are often overlooked. Our intention is to elevate intellectual conversations around the bid process by speaking to the white foxes that are easily berated, but which will make the difference between a winning bid and another which only satisfies the key requirements of the regulators. It is therefore my pleasure to introduce my guests, Mr. Nathaniel Oyatogun and Mr. Luqman Agboola. Mr. Nathaniel Oyatogun currently serves as the CEO of Aspen Energy Limited, an integrated energy company established to provide expert services across the upstream, midstream, and downstream sectors of the energy value chain, with emphasis on gas. Prior to Aspen, he was gas customer relations manager at Seplat Energy PLC. Before then, he was senior commercial advisor at Shell Petroleum Development Company. Mr. Oyatogun played a leading role in the development of the Nigerian Gas Master Plan, the Petroleum Industry Act, PIA, the Nigerian Gas Transportation Network Codes, among others. He is a published author and a seasoned thought leader in the global petroleum and gas industry. You are most welcome to Simply, Mr. Nathaniel Oyatogun.
Thank you very much for that introduction.
And to my next guest, Mr. Luqman Agboola, on the other hand, is a consummate finance professional whose career in banking and financial services spanned 30 years with varied experience across energy, infrastructure, trade finance, investment banking, and corporate restructuring. He has participated in major local and international debt and equity transactions in the Nigerian energy sector. He is currently the CEO of Sofidam Capital Limited, a financial advisory and consulting firm providing strategic planning, structured finance, and tailored debt equity solutions to help businesses access capital and execute sustainable growth. You are most welcome to Simply, Mr. Luqman Agboola.
Thank you for having me, and good afternoon, Mr. Nathaniel.
Good afternoon. Thank you, Mr. Luqman. It's a pleasure to meet you as well.
It is such an honor and privilege to have you both on our podcast couch. This licensing round is unfolding at a pivotal moment for Nigeria's energy economy. The federal government has brought forward a portfolio of 50 oil and gas assets in a strategic move that has the capacity to reset the entire industry, injecting fiscal urgency, capital discipline, and market credibility. The government defined its intent to see these fields sufficiently funded, technically developed, and rapidly converted to sustainable petroleum assets while positioning Nigeria as a rule-based jurisdiction. The Nigerian Upstream Petroleum Regulatory Commission has put a clear framework in place. The process has commenced, expectations are well defined, and the market understands what is formally required to submit a bid. What receives far less attention, however, is the work that happens before any expression of interest on any of the blocks. The strategic decisions that ultimately determine whether a bid is credible, competitive, and capable of surviving beyond an award. Today's episode is therefore not about restating what the bid guideline says. Instead, we are interrogating the commercial, technical, legal, and structural decisions that serious bidders must confront behind closed doors before submission to determine the outcome of the process. Now that introductions are done, permit me to jump right to my first question. I would like the both of you to give me your perspective on this question, starting from Mr. Oyatogun. What is your general sense about this bid round? How do you read the posture of the government and the level of investors' confidence in the current unfolding process?
Thank you very much, Precious, for your question. So first, you want to know what is the federal government's posture? I think it's very, very clear that the federal government has a posture to make sure that this bid round succeeds appropriately. And so you will notice that shortly after the kickoff on the 1st of December, there has been a change of guard at the leadership. So that points to the fact that the government is serious about it and the government wants it to succeed. So because of that change, a lot of some things were initially delayed, but everything is back on course. So the pre-bid round, the pre-bid conference round has taken place for clarification. The government, the target towards 2027 and then 2030. The only way you can do that is to have new development, apart from working the existing asset. So the truth of the matter is that you put your money where your mouth is and you follow through. The body language from the government is that they want it to succeed. And one of the things that they did early enough is to make sure that they streamline the signature bonus so that you can have a level playing field sort of for everybody across the industry. And that stimulated many more players into the industry. And then we begin to see the success story of the small players, the marginal field players, the independents, and then the international oil companies. All of them were present at the kickoff meeting, which shows that everybody is still interested because Nigeria is a viable province, to do business in the oil and gas sector. So that's my take at the strategic view and the body language of the government. Thank you.
Thank you so much, Mr. Nathaniel Oyatogun. From what you have said, I would want to ask, this posture of the Nigerian government at this time, does it have anything to do with the previous bid rounds that we have had as a country?
So when you look at the previous bid rounds, as they would say in the local parlance, you get as it be. The 2020 marginal bid round, there were some issues, there were some challenges. And then the mini round sometime in 2024, coming shortly after the PIA has been embedded. The PIA makes it clear that the process for block allocation is no longer discretionary, but it has to be by competitive bid. And one of the key indices is to have a level playing field for everybody, which is what NUPRC has tried to do in the regulations and the guidelines that they rolled out. So the government wants to succeed, and different from the previous ones where the signature bonuses were high. And so some people, after winning the bid and the blocks and coughing out the huge signature bonuses, they now have to go shopping around for financing. But this time around, the government is saying, no, before we go ahead, I want to see your technical capability, that you can actually perform with a credible technical team that knows what to do. And then alongside with that, we want to see your financing plan and the opportunities so that it is not going to be that you win the block and then that's when you are now going to shop around for funds. So before you are invited to submit a commercial bid or a commercial proposal, you would have been pre-qualified technically that you have a sound team, you have a good understanding of what it takes, you have the technical wherewithal to make sure you evaluate the opportunities very well, and then you are ready to go. Then we can invite you to come and show us how you intend to finance it. So that's the slight difference from previous round. Previous round, there was not too much attention, to ability to pay or to deliver a work program after you have won the block. But now, this time around, government wants to make sure that a lot of front-end loading, as we call it in the project management, is carried out to ensure the success. Because between now, if you look at between now and 2030, we have less than 4 years. And some of these blocks, it takes time to evaluate it, put a work program in place, drill, test, and then once you hit commercial success, you then begin to produce. The government has said by 2030, we need to produce more than 3 million barrels per day, and then also have gas production in such a level that we have more than 12 BCF per day. So all these things will not happen if you have people that will wait 5 to 6 to 10, 20 years before they can come to production. Thank you.
Thank you so much, Mr. Oyatogun. Mr. Luqman Agboola, I would like to hear your perspective on the question.
Yes, thank you very much for the question. Just like he has rightly said, one of the major attractions that I'm seeing here is the signature bonus. If you look at the current proposal compared to what it used to be when you have a bid round that is this large and of this magnitude, the signature bonus is always very, very high. And that is a constraint for bidders. Of course, what you are seeing is to align the Nigeria environment to the global standards with regards to what is happening currently. Excuse me. But of course, you also need to realize that, just like you also said, Nigeria is high prospectivity environment with high possibility of getting good results from your acreage. That is what history has told us. So chances are that you are going to have a good number of people participating in the bid. Also, don't forget that in addition to that is that, again, just like he has rightly said, things are being streamlined because if you look at the Nigerian oil and gas sector in the last 15 years, if I must say, it has been stagnating. And the reason for that is because there are no clear rules, if I could use that word, to guide investment in that space. So I think with all those obstacles being taken out of the way, I think there's going to be a lot of interest. But of course, given what NUPRIC is currently doing, the roadshow, the meetings and all that, and the body language, we hope we are going to have a good bid round. In addition to that is the fact that on the government side, the resources in terms of reserves is depleting. In the last few years, and I would say up to 15 years now, you have not seen a lot of activities in the seismic space. That is where you do your exploration, where you look for active exploration to determine whether there are new discoveries and all that. So if the government is really interested in increasing our reserves, and the only way to do that is to have new bid rounds and ensure that those bids are successful. What makes them successful is not just that people are interested in bidding and winning. It's about putting the money into the business and achieving the real objective of discovering oil so that we can increase our reserves. And at the end of the day, it is of benefit to the government and the citizenry. Thank you.
Thank you so much, Mr. Luqman Agboola. From what has been said, it is very clear that asset selection for every bidder must be a very strategic decision. And that leads me to my second question. Mr. Oyatogun, I would like you to provide insights to this question. Beyond the geological data, the physical framework, the work program requirements, and the technical and financial capacity, what other strategic consideration typically influence a bid selection of an asset, especially considering that each bidder is only entitled to submit a maximum of 2 bids? So in particular, how does factors such as anticipated competition intensity, perceived government strategic interest in certain assets, and the overall hits around specific fields shape how bidders decide where they realistically belong and where they may deliberately choose not to compete?
Thank you very much. So there are quite a lot of factors that come to play in addition to the things that you have mentioned. So when you look at the current bid round, 50 blocks are on offer, so it's kind of wide. And the terrain you have onshore, you have shallow waters, you have swamp, and then you have deep offshore. And then you have, in addition to those, you also have the frontier basins. So the Chad Basin, the Dahomey Basin, the Benin Basin, and then the Benetra and Anambra. So that diversity already means that you are looking beyond the geology of the area. But one thing that comes to play is that people decide to go into a particular area in addition to whether the geology is right. There are many factors that are outside of those traditional realm. So the first thing is what could be tagged a wish list. And by wish list, what do I mean? So an organization can decide that we would like to have asset in this area, and it's part of our wish list. And why do we make it part of our wish list? We want to consolidate our operations. We want to improve our economies of scale. So since we already have a terminal or we have an evacuation route in this place, we would like to source for additional growth opportunities in the vicinity. So that's a wish list. Additional reasons could be that you are privy to some intelligence, intelligence in the sense that beyond the data that has been acquired, maybe you want to test the limit of artificial intelligence, for instance, to see, can we sweat more in this area? Is it a producing field? They are producing fields in the vicinity. And as Mr. Luqman mentioned earlier on, you know, success rate in Nigeria has been quite interesting and impressive. And particularly when you look at gas, we are talking of 215 TCF of proven reserves. You could be interested to take part in the current trail of the decade of gas. So government is bullish about gas and gas to power. And we see many producers transitioning from just oil company to oil and gas and integrated energy. Some are even trying to do gas, power, and then they sell the molecules to the populace. So that's another reason. Another reason could be, you know, beyond the intensity of competition, how many people are choosing a particular area, you might want to say, okay, I'll skip this one and prepare for the next bid round. Or the terrain itself might make it that it's only those who have deep pockets. For instance, a couple of years ago, when the OML 245 that became famous for a lot of reasons, you saw two big players, Shell and ENI or Ajib. They were the ones who went after that because it's in deep water, and even though the reserves there are huge, but then to make it come to pass, to be successful in developing it, you need a lot of money. You need, you have water depth that is beyond the conventional. And because of the huge reserves, preliminary studies, you want to have that. So that's another thing. Some people want to stay quiet. Some people want to be in the crowd. And when you look at government strategic interest, it will shape how you move. I had mentioned the interest about gas, or the focus about gas. And there is also what we call strategic positioning amongst the players. You want to go after a particular field or block because you know that if you make a huge success of it, you will be happy. But if you miss it, it will impact on your reputation. So it's a catch-22 situation. But in all these, the key thing is that you must have the technical capability to do the quick assessment, because remember, the window of opportunity for you to make a bid is small, and you first have to prove the technical before you then say, this is how much I'm willing to pay in terms of the commercial, or this is time to development and possibly first oil if we find oil in commercial quantity or gas in commercial quantity. So those are things that come to play. Thank you.
Thank you so much, Mr. Oyatogun, for that insight. So while you were speaking, I would largely assume that the information that will aid any strategic decision by the bidders will not only be restricted to information that are available on the general internet or the news at large. So that will lead me to my next question. And I would like Mr. Agboola to provide insight on that question that is centered around market intelligence and bidder positioning. So I would want Mr. Agboola to provide insights to this question. So to what extent does market intelligence, such as understanding of competitive dynamics of the different assets, levels of investors' interest, and government perceived intent for each of the assets, and other unspoken market signal, how do they influence how a bidder should position in this licensing round?
Thank you very much. I will start by talking about market intelligence itself, which is a systematic collection, analysis, and interpretation of data relating to markets with regards to what we want to do. Oil and gas is an international business with international coloration. So in bidding for an oil and gas asset, the objective of bidding itself, or any other investment decision for that matter, should be based on the expected return on investment. But just like you rightly said, outside of whatever the noise is the fact that for this kind of bidding, or any bidding for that matter, because of the amount of money that is involved, you must do your own analysis ahead of time. You must do your own investigation ahead of time. And those investigations will revolve around what information do you have with regards to the assets, particular assets you are going to be bidding for. Just like Mr. Nat Oyatogun said, these assets are so many, and you may not want to play in a particular environment for various reasons. But of course, the first thing you need to know is with regards to the data of that asset, how are you able to use your relationship and connections to have an insider intelligence with regards to the data supporting that asset? How reliable is that data? That is very, very important because it's going to determine how much you are going to be putting on the table. It's also going to determine what your cost of investment with regards to, bringing that asset into production and making it profitable at the end of the day. So things such as the data quality and reliability, because again, chances are that, just like you rightly said, you are not going to see them in the data room that NUPRIC is going to make available to you. The other issues you must also consider internally is with regards to your pocket, because that's also going to determine what kind of assets you should be looking for. As he has also rightly said, one of the things we've seen in the past is a situation whereby people will win bids and not able to even meet up the signature bonus payment, and where they do, they are not able to develop the asset. The other thing you must also consider is, so what kind of partners you may need to go to bed with. That is also very, very important, because if you are not careful and plan properly before you get into the bid, chances are that you are going to be under pressure and go to bed with just anybody, and it's going to be a problem at the end of the day. So also is the environment in which you want to operate. And with all due respect, thankfully enough, we have the problem of communities and all that has receded now. But of course, that is one of the things that bidders also try to look at, especially the IOCs, and that is why, again, you saw all those divestments and all that. So these are some of the issues that are not out in the open there that you need to take into account by doing a very, very good, by having a very, very good market intelligence. Thank you.
Thank you so much, Mr. Agboola. On this same issue, Mr. Oyatogun, is this market intelligence even important? And would you say in any way that it colors the transparency of the process?
Yeah, I mean, the market intelligence is very, very important. And there are many sources where you can try to get your market intelligence from. When you look at it, the conventional ways of the data is that you are relying on what has been provided for you. Now, in some cases, some of the blocks, you have limited data. So a lot of exploration work is required. And you then have to use market intelligence to see how best you can get the data. You can network with academic institutions that are doing maybe regional work or analysis of data in a particular province. And by extrapolation or interpolation, you could deduce that maybe you can use the analog data from one area close to another one, if some parameters are similar. Or you could key into what we call alternative ways of getting your data, and you're looking at the various surveys, and in these days of artificial intelligence, you could develop some software, machine learning, artificial intelligence to try and query and narrow down uncertainties. But for you to be able to do that, you must have acquired the data, or you have access to a large data that you can then query and try to fit into that. So because most new players that want to go into the sector, they don't have deep pocket to have those kind of leading edge tools. You then have to rely on the data that is provided by the regulatory authority, and then apart from the one you can get from the National Data Repository, there are also joint studies or crowd-funded data mining. So some companies come together, they put some money, they acquire seismic data, and they hope that after interpretation, they can sell it or make money out of it by getting those who are interested to come and look at it. Another thing that can help you in your market intelligence, if, for instance, a block has been carved out of an existing producing area, all right, then you could try to reach out to the owners of those blocks and see where you can get some data. So again, you're leveraging on market intelligence. But beyond all that, is that you need to look at what is the strategic direction of the company, of the country where you are operating, and in this case, Nigeria, because that's the current bid round that we're evaluating. So what's the dance of the government? The dance is that government wants to increase oil reserves, and government also wants to increase gas reserves. Mr. Luqman mentioned earlier on that for some time we have not been able to replace the reserves that we're producing. So our reserves replacement ratio has been on the low side. Government wants to change all that. And then also, by investing in value of information, you pay a little sum of money to acquire some more intelligent information that will help you to de-risk the evaluation that you are trying to do. So those are the ways that you can overcome, or you can leverage on market intelligence to overcome the challenges that you have.
If I may add to that, you had also inquired about, coloration and some level of interest. Transparency. In a bid like this, every participant will try to use every avenue, every opportunity to get the required information, however and wherever it is available. That actually does not, bring lack of transparency into the whole process. For as long as the guidelines that have been set, the rules that have been set are duly and properly followed, I think it's a standard process for entities who are interested in bid rounds to look for intelligence. Just like Mr. Nat has rightly pointed out, the most important thing is you getting the right kind of data that is going to support your investment decision at the end of the day. And whatever you have to do to get that is very, very important for your business. Otherwise, you could end up throwing a whole lot of money down the drain. Thank you.
Thank you so much for that insight, Mr. Luqman and Mr. Oyatogun. So my next question is on the contractual and commercial side of the process. So Mr. Agboola, when you look beyond the upfront bid metrics and the headline fiscal terms, one decision with major commercial implications is the choice between a production sharing contract and a concession model, particularly given the federal government's statutory backing rights in concession assets. In your opinion, do you think that Nigeria will gain more under the production sharing contract than a concession model? And also, will it work better for specific acreages?
Again, thank you very much. I think the choice will be that of the investor at the end of the day, because both of them have their pros and cons. The major decision influencing the decision will therefore be that the bidder's appetite and the willingness to go either alone, which is a PSC, or what with government, if and when it's required in case of concessions. As rightly pointed out, the approach adopted really affect the asset valuation, cost recovery assumptions, and long-term risk allocation. But again, if you look at what has been going on and with historical hindsight, I think a lot of people who will be bidding, who are really serious, would naturally want to prefer a PSC, given the experience, we have had with concessions where government is a participant. So, but of course, government participation also has its own advantages in the sense that if, for example, government is not bringing its own contribution in a concession, then you can't blame the other party for not bringing their own funds into the concession to fulfill development. So at the end of the day, I think it's a function of what exactly does the bidder want, and what is their business strategy and all that. So that is what I think will drive whether a participant or a bidder would go for either a concession or PSC. Thank you.
Thank you so much, Mr. Luqman. Mr. Oyatogun, please, I would like to ask, considering that this contractual structure would have impact on asset valuation, cost recovery, and long-term risk allocation, would your approach be different?
Well, I mean, the key thing, the standard process within the oil industry, and not just the oil industry, the gas industry, as well as any business, is that you want to park the risk with the person that is best suited to manage that risk. So the choice of whether you go into a PSC or a concession is actually yours. But I mean, Mr. Agboola had mentioned some of the benefits, the upsides and the downside in each situation. So if you're going for PSC, okay, you are a contractor, you carry the risk, you go ahead, but then you share accordingly, and there are frameworks for you to get the benefit of your investment. If you're going with a concession, and if you're going along with the government, because government would always have interest. The thing is that traditionally, I mean, government will always pay its debt, but when will they pay it is another matter that you need to look at. Because take, for instance, currently, if you look at the gas and power value chain, there is some disconnect. The weakest link is the disco collecting the money. And so power has been generated across some years. It's been supplied to the discos. The discos have sold the electricity, but they have not collected all the money. And then to generate the power, the gencos have had to buy gas, and they have not been able to pay fully for the gas. So there's a disconnect. Now, what government had to then do is to make sure that you attract more investment and improve investor confidence. Government recently raised a bond to try and clear the backlog. And that bond, I think, was concluded sometime last week. It was fully subscribed. But that's just a drop in the ocean, because when you look at it, as at the last time I checked, the gas and power sector was being owed in excess of 4.3 trillion naira. And then if you convert that to dollars, you know how many billion dollars that is. That's so huge for you not to produce gas and not get paid. And so the key thing now is that people want to go into the business, but they want to get assurance that they will get paid. So from a risk allocation point of view, let the person that is best able to manage the risk, let him bear that risk. And if you're going to make a change or you're going to tweak, I mean, because government was the backstopper, that's why government had to make sure that it raises the bond to be able to sort out that debt. Otherwise, nobody will come and invest. I mean, there has not been any new investment in the power sector for a very long time. I mean, the Azura project was a model in a bankable project, which was the gas supply, the electricity generation, the PPA. There was back-to-back alignment with all the risks and liabilities, all the provisions, and but you've not had new ones like that. And I mean, last week there were 2 grid collapse, in a row, and that's because we're still not managing the entire risk as well as it should be. So that's the way I see it. Let the person who is best able to manage the risk, let him bear that risk, but he has to get good value. So if you're asking a private sector person to bear the risk, then he has to get good value for carrying out that function. Not that you just expect him to keep producing power or supplying gas without getting paid. But anyway, that's subject for another discussion. So with respect to the bid round, what is important is that people are able to see through the line of sight, for them to do their evaluation, for them to be successful, for them to have a work program that is credible, and for them to be committed. There's enough fund to actualize the dreams, and in no time we will increase the production. And if we increase the production, if we increase our reserves, we will increase the production, we will earn more revenue for the country, for the government, we will get more taxes, we will get more opportunities, and we will stimulate growth in the economy. We will improve our foreign reserves. We'll be able to stabilize a lot of things. So that's the holistic way to look at it. Thank you.
Thank you so much, Mr. Oyatogun. My next question is on the financial side for bidders. Mr. Agboola, beyond the technical and legal requirements, the 2025 licensing round imposes significant upfront financial commitments, from bid guarantees to multi-million-dollar signature bonuses. For small indigenous companies or link consortia, how should bidders think strategically about structuring these financial obligations? Are there recognizable financial instruments or structures that can help manage upfront capital exposure without weakening the bid credibility?
Thank you very much. First, I would like to start by comparing the previous bid rounds with this. Just like we had pointed out earlier, I think this is, if I can use the word, this is one of about the cheapest bid rounds we've had in a long time, apart from the what do they call it, the marginal field bid rounds, which again, as we had pointed out, is a very, very good sign. But of course, beyond the signature bonus and bid guarantees and signature bonus, it is very, very important for indigenous companies to decide what they wanted to achieve ahead of time. In the bid round, what exactly are they bringing to the table? Is it technical capabilities? Is it financial? Of course, financial is a problem. So they must be valuable in a particular sense or in a particular way, to attract further funding after the signature bonus and all those payments that are attached to the bid round. Because as you are aware, oil and gas business is very capital intensive, and you must, as Stephen Covey said, you must begin with the end in mind. So what is the end? The end is to ensure that oil is produced in a way that is beneficial to the investor and the government. Yes, there are funding structures and options and sources, which includes equity, farm out, FTSA, which financial and technical service agreement. You have quasi, which is debt and equity. You can also do capital market listing before we go into debt financing and others. Now, what strategies do you need to put in place to ensure that your program is successful? From experience, given the kind of assets that are being bidded for, unlike the marginal fees that you have some level of information before you go into the bids. In this case, you are actually bidding for assets that are still greenfield, if I could use that word, and the risks are very high. So the most important thing for indigenous companies who are going to be participating in this, especially if they are small, is they must have done their homework very well and determine what exactly they are bringing to the table. Because at the end of the day, they are going to be needing partners to come in to work with them. Otherwise, they may not succeed at the end of the day. So is it technical capabilities? Is it relationships at the top level and things like that? That's number one. Number two is also to be able to attract high net worth investors into your license, license by having a very, very good, a robust, field development plan that shows what work program you are going to be getting involved in, what time frame is it going to take, as well as when is your time to market, because these are the things that hard-nosed investors who you are going to be looking for at the end of the day are going to be interested in. Without that, you are not going to be able to do anything. So at the stage of bid round, up to your first oil, most of the time you are going to be depending on equity, farm out, FTSA, quasi, and capital market listing. Those are the options you have at that stage. Post your first oil, because when you get to your first oil, those are the things that are going to be telling us, whether you are actually qualified to get debt financing. And of course, that is going to be a function of your reserve as well as crude oil prices. So at that stage, you could approach banks to do all kinds of financing structure for you, starting from plain vanilla loan, which is a direct loan, to reserve-based lending, project finance, and all that. You can also approach at that stage international oil traders to do prepayment financing, pre-export, securitization, and all that, including forward sale. But generally speaking, your funding structure is going to be a combination of equity, debt, and all other kinds of structure, in that way. Because at this stage, no debt provider will want to come in. So you must strategically present yourself in a way that ensures that, your financials projected are believable and, can ensure that you achieve your objectives. Otherwise, nobody is going to touch your asset. Thank you.
Just on that same question, I think financial capacity is another area where bidders sometimes conflict balance sheet strength with bankability. In your opinion, how should bidders think about the difference between financial capacity, funding strategy, and true bankability, especially in an environment where capital is cautious, project finance is selective, and assumptions are closely scrutinized?
Thank you very much. Actually, in truth, balance sheet strength is a very important factor to consider, especially for licensing round of this nature, because a lot of sunk costs are going to be involved. But of course, just like you have rightly said, conflating balance sheet strength with bankability could end up being a costly mistake. So the first step for any bidder is to determine how much financial risk it is willing to take and what are the expectations. That will, enable the bidder to determine which assets to bid for in the first place. Again, just like Mr. Nat Oyatogun said, the IOCs would prefer, assets that have, large deposits. But of course, those assets are cost intensive, they are capital intensive, and time to market is very, very long. So these are things that must be taken into account, when you are bidding for a particular asset, not just your balance sheet size. Again, just like you have rightly pointed out, bankability and balance sheet strength are two different things. You could have a very, very robust balance sheet that could even support the project, but of course it's not bankable. So what determines the bankability of the project? Again, it still boils down to the same thing. It's all about your reserve and what it will cost you to bring it to the market and to see whether it is profitable or not. So in determining whether what you are going to be doing with your asset, while financial capacity will give a bidder a good head start, a good funding strategy will enable the bidder to have access to financial resources when it is required. So you must plan your assets development in such a way that funds are available as at when they are required, because of course, again, even when your balance sheet is very robust, you may still need to approach the debt market and all sorts of other funding to ensure that your asset is gets to production and is profitable at the end of the day. So while balance sheet strength will enable the bidder to de-risk the assets in a timely manner, a good funding strategy ensures that project is not delayed, while bankability analysis will ensure that the asset is profitable at the end of the day. Thank you.
Thank you so much, Mr. Agboola. Now let's talk about partnership and consortium strategy. Mr. Oyatogun, for foreign investors or IOCs participating in this licensing round through consortium structures, what are the critical metrics that should guide the selection process of their local partners? Specifically, what weight should be allocated to factors such as political influence, financial capacity, technical and operational competence, and local knowledge when making the selection of partners, bearing in mind that local partner selection directly influences consortium governance, risk allocation, decision-making control, and post-award execution. How do these implications feed back into the initial choice of local partners, particularly in determining equity participation, operatorship, and control within the consortium?
Thank you very much, Precious, for that question. So let me start by saying, when we're looking at partnership, whether for IOCs or for international investors that want to play during this bid round, since there are 50 blocks on offer, and you're not allowed to bid for more than two blocks. So it means government wants to diversify, the opening to make sure that it is not concentrated in the hands of a few. And, they are going to check who is behind each of the consortium. And if you are linked in any way, then you will forfeit anything above 2 blocks. I think that was what they said at the pre-bid round conference and clarification session. So what is important is that before you can select a local partner, there are certain criteria, and you have listed a couple of things, and let me just take them one after the other. So the technical and operational competences matter so much, because if you don't have an operator that is technically and operationally competent, then you can have the best work program. It will not get done. It will be poorly executed, and there will be issues which can then cost you more in terms of finances, in terms of fines, in terms of loss of reputation, if things go wrong. So it's very important. In executing the work, we must pay close attention to health, safety, and environment, and community awareness and protection, following the ESG compliance to make sure we care for the environment, we have sustainability goal in mind, and we do things right. So technical and operation competence, I would say about 30% weighting factor, or 30 to 35%, depending on who you're partnering with. And then when you look at local knowledge, contextual intelligence, and knowing the ground, the grassroots, I will apply a weighting factor of, say, 20 to 25%. And that matters because you need partners that can help you navigate the complex community relation issues, security management, local supply chain, social political navigation. If you don't get that right, it can impact on your consortium. And you don't want to have delays, unrest, or reputational damage from poor stakeholder engagement. Then when you look at financial capacity, I would say about 20% weighting factor, because there must be the ability to fund. So even if you are going to carry the local partner, there must be a point where there will be sustainability. So you can't carry them forever, otherwise it would not be sustainable, because that could lead to agitation and a lot of other issues. And then when you talk of political influence and regulatory connectivity, most people want to stay away from politics, because it could be this party today, it could be that party tomorrow. And when you look at the life of your license for your acreage, 20, 30 years, you want some certainty and you want some guarantees. So political influence and regulatory connectivity, very important. Not that you will go into politics as part of your oil and gas business, no, but you must be able to navigate the regulatory environment to make sure you're in good books of the regulator and you don't run foul of the local law. There's the local content expectation. There is the capacity building, capacity development. There's market credibility and reputation. I will assign about 10 to 15% weighting factor to that, because that also matters with the regulators and financiers and the industry peers. So, having said that, what is the critical feedback loop that you need for proper governance of the consortium? You need to have your equity participation clearly stated, clearly spelled out. There should be no ambiguity. There should be no ambiguity, all right? Then operatorship is very critical and very, very important. The operator must be one who has the capacity to carry out operatorship, and it should technically rest with the technically strongest partner. So you can't sacrifice operatorship, because that's what brings in your revenue. If you're not able to produce, if you're not able to interpret what is happening to the wells, what is happening to your facilities, what is happening to your pressure depletion, what is happening to your field development planning. Are you operating in accordance with plan? Are there surprises? Are there gaps? Are there things that you did not consider when you are doing your field development planning? So operatorship is key and critical. And then control rights and governance. So as I said earlier on, you don't want your oil and gas company to be a political party or an extension of a political party, because then that will create problem for you. But you want to put in place a governance framework that is sustainable, that works. So you have on one hand, a business to run. On the other hand, you have a team of competent people to run the business. Where those two merge, then you will have profitability. And when you have profitability, you can grow your business because you are generating surplus cash that you can use to grow, to make new investments, to spread your wings further afield, to look at new opportunity, to go down the value chain. So maybe from upstream, you want to go down to midstream and get more benefits from the incentives and the PIA for midstream, or you want to go downstream. So when you get your balance of control and governance right, you wouldn't miss it. And then finally, risk allocation. You don't want to handle all the risk. As I said earlier, you let the best person who is able to manage a particular class of risk handle it. And in risk mitigation and risk management, we have different methodologies for reducing the risk. You either manage the risk to a level that is as low as possible. We call that a LAP, or you transfer the risk by taking an insurance, or you manage the risk by trying to reduce it considerably, or you partner with people who can help you to manage that risk. So there are many models for managing and absorbing risks. We need to be aware of that. So in a nutshell, what will happen is that operatorship, when you're forming a consortium, is key to the sustenance of sustainability and also profitability. Equity allocation should be equitable and just, and governance rights should be clearly stated. You should have a document that is not cumbersome, but simple and straightforward enough to stimulate trust, engender camaraderie, engender collaboration, partnership, not antagonism. You don't want, when you form a consortium, that you will now spend the rest of the year in litigation or arbitration or any form of intervention to try and resolve crisis. Rather, you want to come together, contribute, and grow. And then local partnership selection is not just about winning the bid, it's about sustaining and ensuring that you have a credible project at the end of the day. Thank you.
Thank you so much, Mr. Oyatogun. So now to the final question. In this licensing round, signature bonuses have been set within value range of $3 million to $7 million. However, we know that not all assets attract the same level of competition. How should bidders approach their signature bonus strategy when bidding for highly competitive premium assets versus more normal or less contested assets? I would like Mr. Agboola to give us his perspective on this question.
Thank you very much, Precious. Yes, it is true that not all assets attract the same level of competition, which should be expected anyway. What makes an asset competitive is not just its location, but more importantly, its prospectivity, based on the available data, as well as the expected project ROI, which investors must take into account when making the decision with regards to what asset to bid for. Excuse me. Again, I will go back to what Mr. Oyatogun said about OPL 245. As we know, it's a very, very big asset, but of course, we've been on it for over 20 years now with all its, politics, if I could use that word. It is only now that Shell is trying to bring in, according to the government and Shell, about 20 billion into that asset. So you can imagine if an indigenous company is going for such an asset, whatever, however prospective or competitive it is, you need to think twice before you do that. Again, of course, we have seen such successes with indigenous companies too, in the case of FAMFA and, Southern Petroleum. But of course, what is important to a bidder is what exactly do you want? Because if you go for an asset that is competitive and you put a lot of money into it, and at the end of the day, it turns out that you don't have co-investors or co-venturers that are deep pocket, you are still going to lose the money you are putting into it at the end of the day. So bidders should approach their signature bonus strategy on the basis of intelligence gathered with regards to the asset prospectivity, development cost, infrastructure requirement, social environment, financial capacity, among others. It is therefore the ability to navigate these issues that will ensure not only successful bid, but also a successful asset exploitation at the end of the day, which is the most important thing and the objective in the first place. So attractiveness and competition intensity with regards to this bid is a function of the investor's appetite, because again, we have seen a situation whereby because an asset was competitive or is competitive, people are putting a whole lot of money into it, and at the end of the day, due to a lot of factors, they were not able to maximize the potentials of those assets. So bidders must be very, very careful and not to join the crowd, but to do their homework very well before, jumping into that so-called competitive asset. Thank you very much.
Thank you, Mr. Nathaniel Oyatogun and Mr. Luqman Agboola for making out time out of your busy schedule to discuss with us today. We are glad to receive from your wealth of knowledge on today's matter of discussion. We would also like to say a very big thank you to our listeners for tuning in. We wish you a happy and prosperous new year ahead. As always, the conversation continues on our social media handles. Do remember to send us your comments and thoughts on today's episode.
Thank you for listening. This podcast is brought to you by Deal HQ Partners. To find out more about our services, visit www.dealhqpartners.com. See you on the next episode.